Is the Fed rate cut finally on the horizon, or the interest rate's going to be stuck at these levels for the remainder of 2026? If you're worried about your mortgage or the stock market, you need to hear the Fed rates decision update. Here's an overview on the federal interest rate. It's actually called the federal funds rate. This is the benchmark interest rate set by the Federal Reserve that influences borrowing costs across the economy. This rate affects everything from consumer loans to business investments and inflation dynamics. So what's the current status? The current Fed rate sits at a target range between 3.5 to 3.75%. Despite high hopes for a cut, the Federal Reserve they chose to hold steady at their last meeting. Fed rates today they reflect a central bank that is it's cautious about sticking inflation. It's sticky because this inflation's been beating the crap out of the American citizen for years now. And as you know, go to the grocery store, fill up your gas tank, you feel it. Because of sticky inflation, it's still hovering about above 2% above the target. So in about a week, they're going to have a meeting. All eyes are now going to be on the next Fed rates meeting, which is scheduled for March 17th and 18th. While the market's pricing in at 98% chance of another pause, many analysts still expect at least one Fed rate cut sometime this year. Potentially as late as December, which means we're going to go all year with the same damn rate. So obviously, when you lower or raise the interest rate, it's good and bad. So right now, the interest rate's high. What are the pros and cons behind lowering the interest rate? Lowering rates generally encourage economic activity by reducing the cost of capital. That means, in layman's terms, it's cheaper to borrow money. What can that do for us? Stimulate borrowing and spending. Cheaper borrowing makes it easier for consumers to finance large purchases like homes, cars, appliances, or boosting overall consumption and economic growth. And hey, United States, we're number one when it comes to shopping. My God, the amount of credit card debt we have as a society a whole, and we're over $1 trillion in debt for credit cards in the United States. So they'll definitely stimulate our purchasing. Now, businesses, they also benefit as lower rates reduce the cost of loan for expansion. So cheaper to borrow money, they expand, they invest in themselves, hiring, and potentially lowers unemployment, which God knows is too damn high in our country. Lowering the interest rate, that also supports the housing and auto markets. Mortgage rates often decline, making home buying or refinancing more affordable. It stimulates the real estate market, and hell, you could get a lower rate on your auto loan. It eases the debt burden. For those with variable rate debts, such as credit cards, interest payments decrease. That's a good thing. They take enough of your money. And some of these credit cards, the companies, the 22 to 30% interest rates, that's insane. If there's any way to lower that, that's definitely more money in your pocket, and it's a good thing. It frees up your cash. If you free up your cash, a few of us fortunate ones out there with enough free cash to go around, it can boost our investment. Stocks may rise as companies face lower borrowing costs, improves profitability and investor sentiment. If you got extra cash, throw it in. I personally say throw it in your 401k or any other investments you may have. But let's get real, guys. Most of us out there, we just trying to get by every week with that paycheck and make it stretch as far as possible. So we don't have any extra cash. If we save any cash with Fed rates being low and down, I don't see us saying, oh, yeah, I'm going to go invest in the stock market. But hey, if you got the funds to do it, obviously it's a wise choice. And lastly, bonds and utility stocks, they may perform better due to higher relative yields. Yeah, it's going to be cheaper to invest in them. All right, now those are all the pros of lowering the rates. But like anything in life, good owns the bad. So the cons, reduces returns for savers. So interest in savings accounts, CDs, and money market funds, they're going to drop. That's going to erode income for retirees and conservative investors who rely on the fixed income yields. Lowering the rate may cause risk of inflation. Risk of inflation. What have you been living in the past 5 years? It's been inflation mania going on. So the excessive easing can overheat the economy. That may expedite price increases. The demand outpaces supply. This erodes purchasing power and may require sharper rate hikes later, which creates volatility. It encourages risky behavior. Low rates can fuel asset bubbles in stocks, real estate, other markets as investors chase higher returns. We've seen that. Remember 2008? The real estate, the bubble burst. So, yes, it's very much a real possibility. Then you have impacts on credit and debt relief. They're going to be uneven. While some loans adjust quickly, credit card rates may decline slowly. What a surprise there. They want to ring me for every cent they can. So now you have a little bit of information on the pros and cons of the interest rate and what the interest rate really is, federal funds rate. The Fed rates decision will be in about a week. Right now, we're on a wait and see period. What do you think? Will we see a cut by summer? Are you preparing for higher rates for the rest of the year? Let me know in the comments. So there you have it with the Fed rate cut. Big decisions coming in about a week. If you enjoy this video or my other content, share, like, subscribe. It helps my channel big time. I appreciate your time. I'll see you soon.